Okay. Hi, very warm welcome to this KPMG webinar. Good morning, good afternoon, good evening, as the case may be, to all the participants joining this webinar. My name is Sunil Badala, and I'm the national leader of financial service sector, tax and regulatory in KPMG India. I have my colleague Anand Shah with me, who also is a partner in the financial service sector in KPMG India. And Anand Shah will actually talk about various tax changes that are proposed in the budget that got presented yesterday. But before that, I will take you through some of the regulatory changes, and also I'll give you a quick introduction of the budget 2021-22. So let me start by saying that probably this is one of the best budget that got presented from a capital market perspective, because it is very much reflected by the fact that yesterday, after the budget got presented, the index actually gone up by close to 5%. It has further gone up today. So if you take into account the closing of the index before the budget got presented and today's closing, it is up by more than 7%, which is, I think, a steep increase. And therefore I would say that capital market has definitely reacted very positively to this budget. And looking at the regulatory and the tax changes that have been announced, you will, I think, agree that this is an investment and growth oriented budget. In my view, it's a very progressive, pragmatic, and again, as I said, positive from an Indian economic perspective. So with that background, let me just go to the first slide. If you can move to the first slide, please. Okay, so as you all know that this budget has actually been presented in very unprecedented times. We've seen the pandemic, globally, after over a century. Obviously, globally there was a risk to economy, health, and our lives. The global economy, as you know, is expected to contract by almost 3.5% in the year 2020. Lots of loss to the human lives, over 100 billion infected cases of COVID with over 2 million deaths. So obviously, this was a tough time, and obviously the yesterday's budget was actually presented in these tough situations. But of course, there is always an opportunity to actually reset the economy. Globally, the economy is actually now expected to grow by 4.5 to 5.5%, and we can actually feel and see the optimism around the globe due to the COVID vaccines being rolled out in different parts of the world, and also a complete alignment of supply chain globally. As I mentioned that from an Indian context, this has been a very positive budget for various reasons. And again, if you just go to the next slide, I'll just give you some data point. So this is what we had. After a record contraction of almost 24% in Q1, we started seeing a V-shaped recovery in Indian economy. There was a modest decline of 7.5% in the Q2 of the GDP, which obviously was much better compared to 24% of the degrowth that we saw in Q1. And if you look at overall degrowth in the GDP for the financial year 2021, we are expecting GDP to actually contract by 7.7%. However, on the positive side, as per IMF, in the financial year 21-22, India is going to emerge as the fastest growing economy, with the real GDP expected to grow about 11%. Okay, and obviously there is a bit of a concern in terms of the headline, inflation, which is averaged 6.6% in 2021. But I think the bigger concern is the fiscal deficit. So, due to the fact that our tax collection actually has come down by almost 25% compared to what was budgeted last year, and even if you compare our tax collection with the last year, it is down by almost close to 5%. Coupled with the shortfall in the tax collection, there was a significant expenditure on account of public health, on account of supply of money and food to poor in the country by way of various relief packages that were announced by the Indian government, and therefore we actually saw our fiscal deficit shooting up to almost over 9% of the GDP, which was below 4% until last year. And obviously India was on the actually path to kind of reduce our fiscal deficit year on year, but this is the year when obviously our GDP, our fiscal deficit actually went down significantly. So, with that in mind, as I said, keeping that background in mind, obviously, the finance minister has done a great job. But on the FPI side again, the positive news was that India is the only emerging market which actually saw a positive inflow from the FPIs in the year 2020. There was also another positive, which is that the startups in India have actually been faring very well, including a record number of around 12 startups which actually made it to the unicorn list last year. So all in all, a very, very positive for the Indian economy and a very positive budget. So with that, if we can just move to the next slide. So getting into the little bit of details, what we saw in yesterday's budget are some significant policy and regulatory announcements, and also some significant tax changes. So in terms of the regulatory announcements, some of the significant ones are that the FDI in the insurance sector has increased from 49% to 74%, or rather has been proposed to be increased from 49 to 74%. In the last year's budget, there was an announcement that insurance intermediaries will be allowed to attract 100% of the FDIs, and we were expecting the rise of 49% of FDI to 74% in the insurance sector, but that didn't happen. So that has actually come in the yesterday's budget. Obviously, there are relevant changes which are going to be made, but yes, directionally it's very, very clear that the FDI in the insurance sector will be increased from 49% to 74%. Is going to come up with some conditions to the effect that at least 50% of the directors in the insurance companies have to be based in India, and of that, at least 50% has to be independent directors. Another significant announcement was that we are going to see a permanent institutional framework around developing the bond market. Again, as you know, that we've been talking about it for years, that India needs to actually develop a robust bond market. So, first time there was a very decisive announcement made by the finance minister yesterday. We have to wait and watch for the detailed guidelines around this. But again, directionally is very clear that we are going to see a very robust framework around developing the bond market. On the lines of IDFC, that we used to have, which used to finance the needs of the long-term infrastructure projects, the government has actually realized that we need to give boost to the infrastructure sector in India, and therefore they are going to develop, they are going to set up a development financial institution which will be, mobilizing funds for long-term finance to the infrastructure, projects. So again, we'll have to wait and watch for the detailed guidelines. There's also a very positive announcement around, coming up with a single securities market code by consolidating number of different codes or different regulations which are in place in India. So we got Securities Exchange Board Act, SEBI Act. We got Securities Control and Regulation Act, SCRA, the Depository Act, and couple of other small legislations. They are all going to get collapsed, and there will be a single securities market code to actually simplify the whole regulations around the security market. So we will again see more details coming around in that space. Also, they have announced that the FPIs will be eligible to invest into the debt instruments issued by the infrastructure investment funds and real estate investment funds, InvITs and REITs. There were some restrictions around some of the instruments which were being issued by the InvITs and REITs, so that's going to go away, and therefore it will give a new opportunity to the FPIs. So again, that's a space that we have to watch for. India has obviously huge problems around stressed assets. All the public sector banks and some of the private banks are actually sitting on huge amount of non-performing assets, and therefore there was a significant announcement in terms of creating a kind of a bad bank, but in the form of an asset reconstruction management company, which will be set up to take over the stressed assets of public sector banks. Again, the detailed guidelines will be announced shortly, but a very good step to actually address the much needed requirement of the stressed assets market. Our expectation is that there will be a participation both from domestic investors as well as foreign investors. So the FPIs which are actually interested in participating in the stressed asset market will have an opportunity to actually invest into the new asset reconstruction management company that's going to come in place. Also, the systemically important NBFCs were actually protected by SARFAESI Act, but that protection was available for resolution of loans which were in excess of 50 lakh rupees. So every single loan which was in excess of 50 lakhs of rupees, 5 million Indian rupees, was eligible to to actually go under the Surface Act. That limit of 5 million Indian rupees has now been reduced to 2 million Indian rupees. So that's a very welcome change for NBFCs. They've also announced and or promised an additional recapitalization of the public sector banks to the tune of about 20,000 crores Indian rupees. Now, this obviously again is a welcome change because the public sector banks in India continues to be starved of capital. There's also a big announcement in terms of privatization of 2 public sector banks and 1 insurance companies, which again is a huge shift in the government policy, and the detailed framework will actually be announced later. Also, the Life Insurance Corporation, which is probably the biggest government-owned corporation in India, they have announced that they will actually divest close to 6 to 7% of the equity stake of the government, and again that's going to give government a huge amount of revenue. So I think these are some of the significant regulatory announcements. If we can move to the next slide. So before I hand it over to Anand, my colleague, to actually take you through some of the key tax proposals, I would just say that the good news from a tax perspective is that there are significant tax exemptions and incentives provided which are relevant for the FPIs, and I think the big good news is that there are no new taxes which has been introduced by the government, because obviously there were a lot of apprehensions that in view of the pandemic situation, in view of the current financial deficit situation that the Indian government is in, there may be some new tax, or maybe there's a new COVID cess which might get announced in the budget, but nothing of that sort has happened. From an FPI perspective, I know that we were trying to push the agenda of rollover of long-term capital gains, etc. But at the same time, there were also apprehensions that there may be some new taxes introduced by the government, but again that hasn't happened. So I think that is again a good news, and I think those are the reasons why this budget has been rated very, very highly by the capital market. I think with those words, I will hand it over to Anand Shah to actually take you through some of the key tax proposals announced in the budget. So Anand, over to you.
Thank you, Sunil, and hello everyone. So in the next 30 minutes, I will take you through the key proposals as are impacting to the non-residents, and we will follow up with questions at the end of it. So as Sunil was mentioning, some of the very important welcome moves in the context of dividends, which the FPIs have been sort of wanting to come, that is something which the government has actually done in terms of this proposal. The first change proposed is in the context of tax withholding on dividends. Now, as you are aware that in the Finance Act 2020, the entire dividend taxation was changed, by which now the recipient of the dividend is subjected to tax, unlike the erstwhile regime where the dividends were tax exempt in the hand of the recipient. With the taxability moving to the recipient of the dividend, there was a withholding requirement in the hands of the Indian company. So the Indian company remitting the dividend had to withhold taxes. Now, in the context of FPI, in terms of Section 196, they were specifically, there is a withholding of 20% which is applicable, which a foreign portfolio investor can ultimately take as a credit, and if the treaty rates are more beneficial, can apply that rate. However, the withholding were supposed to be undertaken at 20%. So now with the cash flow stuck, the government has made that the withholding tax by the Indian company would be undertaken at the rates which is more beneficial under the tax treaty versus the act, and therefore the foreign portfolio investors who can provide the TRC can now take the beneficial rate as per the treaty. So that's a welcome move as far as the FPIs are concerned. The second element is in the context of advance tax liability on dividend. Again, advance tax, as you may be aware, is something which assessee has to they have to compute the advance tax for the whole year and pay in 4 installments to the government. However, when it comes to dividend income, there is always it's spontaneous and it's dependent on the company with company issuing the dividend, and therefore there was always a case where a 234C penal interest, which could have been attracted because of the fact that the company has not been able to estimate the amount of income that it is earning, and therefore the entire issue with respect to the charge. Given this, the change proposes that now advance tax liability, when it comes to dividend, the entire tax with respect to the dividend can be paid in relation to the next installments and would not attract a 234C liability for not payment of taxes in installments. So again, a very important change as far as the advance tax liability is concerned. The third change, again in the context of dividend, is that the payment of dividends which is made by SPVs, the SPV holding the underlying REIT InvIT asset, were tax exempt in the hands of the REITs, but still the withholding was something which was continuing to sort of get this again sort of the entire cash trap with respect to this is something that the government wanted to take away with, and therefore now going forward the SPV will not have to withhold tax when the dividend is paid to the REITs and InvITs. Again, a welcome move. Next slide, please. The next important, important change is in the context of sovereign wealth funds and pension funds. Now, again, in the Finance Act 2020, a special regime as far as sovereign wealth funds and pension funds were announced, under which dividend, interest, and long-term capital gains, which the SWFs and pension funds earn from investment into infra projects, are not taxable. And this regime was obviously subject to certain specific conditions, which is applicable both to the SWF and pension funds, and also the fact that the underlying SWF and pension fund has certain criteria to be followed at their own country level. So again, the fact of there were representations which were made that some of the conditions were pretty onerous, and not many SWF and pensions were able to comply with a lot of these conditions. So to augment and to create an environment where they can invest more in infra projects, which is the key for the finance minister at this point in time, certain important changes have been made in this regime. Now, the first change is in the context of the vehicles in which SWF and pension funds can invest. So two specific new changes which is brought about where now investment will qualify. The first one is permitting the SWF and pension funds to invest into the holdco. So if an investment is made in an holdco which is holding the infrastructure company to the extent of 75% investment in infra, will qualify for again the exemption. Same way, if the investment is made in NBFC, which has an outlook of development, which is financing infra projects, again those will qualify for the exemption. And AIFs, where erstwhile 100% or rather an AIF which qualifies for the purpose of investment is the one which 100% holds the infra assets. There, the limit is now reduced to 50%, and to that extent, if a Cat 1 and a Cat 2 AIF is investing 50% to the extent of infra projects, they will qualify for the purpose of the exemption. Now, the limits of 75%, 90%, 50%. How does one look at it in terms of the timing, in terms of the day when the investment happens? All of this will follow. The government will come back with specific guidelines. But at this point in time, the section is worded to provide this benefit. Naturally, with the fact that the investment is limited to 75, 90, and 50%, the corresponding exemption will be limited to the proportionate amount representing the infra assets within the investments. The other important again conditions were that no loans or borrowing. So, well, the pension funds and SWF and pension funds were not specifically barred to take loans and borrowings. Those loans and borrowings should not specifically be for the purpose of making investments in India. So loans and borrowings could be with respect to for other investment, but not for the purpose of making investments in India. One of the other troubled condition was about the fact that the SWF pensions cannot undertake commercial activity, which was very anomalous in terms of what it actually meant in terms of its operationability. This condition has been removed, and now the fact of the matter is that instead of they cannot participate into the day-to-day operations. However, they can appoint an ED or a director to monitor investment, which will still not be considered as participating in our day-to-day operations. So they cannot participate in day-to-day operation, but still can appoint a fiduciary person or a director to monitor these investments. Again, that's something which relaxes and creates, the condition is relaxed. The other element was, again, in the context of pension funds, was that the pension fund should be liable to tax in the context of its own jurisdiction, and there was a lot of uncertainty as to what do you mean by liable to tax, because a pension fund might be not taxable in the home jurisdiction because of the fact that a pension fund is specifically exempted in its home country because of its nature of business. But how would it satisfy this condition? So a specific mention of liable to tax is now defined to mean that it should be subject to tax but subsequently exempt. So even if the government, so while the overall regime provides for a taxation of an entity, but there is a specific exemption which is carved out, and that should qualify to be as liable to tax. So again, very important elements of changes. More of these were actually representations to the government, so that the regime can be more conducive, and the specific players can be definitive in terms of where they can specifically put the money and still qualify for it. So that's the changes announced in the context of SWF and pension funds. Going to the next slide, which is in the context of IFSC. IFSC, as you may be aware, is a specific zone within India which is being carved out to be considered as a zone outside of India from a regulatory perspective, and can undertake a lot of activity in the foreign jurisdiction and can enjoy tax benefit. So a lot of efforts is being put by government to create more and more environment for IFSC to prosper, to sort of shift a lot of companies to be in IFSC, and as an impetus to this, several measures have been announced. The first one is the safe harbor condition for fund manager. Now, fund manager in India, in terms of Section 9A, is allowed to undertake fund management activity and still not create a permanent establishment for a foreign fund. However, there are onerous conditions surrounding that. Now, to sort of get away with that, government has now specifically made specifically carved out that if the fund manager is located in IFSC, all of these conditions or specific conditions will be waived out by the government. So a fund manager in IFSC can now enjoy the benefit and have the relaxed condition. So that's one important change which has been brought about. The second is in the context of the entire aircraft leasing. Aircraft leasing is something which the government is very keen to promote in India, and to that extent, the units which are set up specifically to undertake aircraft leasing will enjoy a benefit of tax holiday. So the two important changes which is announced is one in the context of lease rentals, which is earned by non-resident from a unit of IFSC is now going to be completely exempt. So that the entire aircraft leasing rental will not be taxable in the hands of the non-resident, and any income arising to an IFSC unit from transfer of aircraft engine again will not be subject matter of taxation in the hands of the unit. So again, some welcome move for again giving impetus to the aircraft leasing business. The government wants to get more and more companies to sort of build here in IFSC and create an environment where aircraft leasing can be given the relevant push. The other change, which is in the context of offshore banking unit. Now, from the IFSC perspective, any bank anywhere in the world can set up a offshore banking unit in IFSC. Obviously, there are certain checks and balances in terms of this, but overall the regime is very conducive. The regulator wants these OBUs to be set up. Again, there are a lot of benefits to the fact that the Indian labor is cheaper. The access to both Asia as well as to the West can be something access to these OBUs, and also the fact that it has a lot of conducive advantage. To bolster that further, the investment division of OBU is now exempted from transfer of any Indian securities that they are holding, the offshore securities that they are holding, certain securities listed in IFSC stock holding, and income from securitization trust. All of these with respect to the investment division of OBU is exempt, tax exempt, and there would not be any taxable in the hands of the OBU, the investment division. Further, any dividend interest received from India will be subjected to a lower rate of 10%. Capital gains on Indian equity. Here, I may say that the OBU which is making investment into the Indian equity would be considered at par with an FPI, and to that extent, the provisions specifically provide that a category 3 AIF license will be required. However, this needs to be slightly changed, because if it is a pure play for foreign portfolio investors, a specific license to the extent of a foreign portfolio investor is needed. So the fact of the matter is there seems to be a little error in terms of how the license is mentioned, but the regime which is applicable would be 10 and 15% as applicable to an FPI for investments made by the investment division of BU into shares of Indian companies. The other element in the context of transfer of non-derivable forward contracts, which is entered by non-resident with the OBU, is again sought to be exempted here. So if there is a non-deliverable forward contract entered by a non-resident, that income will be not taxable in the hands of non-resident when it deals with an offshore banking unit. Next slide, please. Yet another important impetus for IFSC is relocation of offshore funds. So funds which intend to entirely relocate from the foreign jurisdiction to the Indian jurisdiction by way of alternative investment funds will have a lot of support. The transfer of capital asset will not be considered as transfer, and therefore will not result into any capital gains. The corresponding benefit is also granted to the unit holders of the offshore fund, And similarly, the carry forward of loss of in the books of the Indian company again will not be impacted due to relocation if there is a change, or if there is any change which requires an Indian company to be largely not owned by the same owners. The ability for that entity to carry forward loss is impaired. However, the specific provision now says that even carry forward of losses will not be impacted. So a lot of benefit if the entire relocation of offshore fund is something which which any of the funds can undertake. Few conditions attached here. The offshore fund should not be resident in India. The activities are subject to investors protection regulations, and there may be certain other conditions that may be prescribed. The resultant fund is a fund which is established as a trust, company, or LLP and can be registered as Cat 1, Cat 2, or Cat 3 in the AIF. Again, this is something which tries to move a fund into an India and specifically sort of use the regime with specific investment managers relocating in India, and try and create a regime which can be conducive for fund management activity through IFSC in India. Next slide, please. All right, some few important changes again in the context of compliances. In terms of specific reopening of audits in India, this has been a little trouble for a lot of non-residents when it comes to planning, because they do not know as to when they should close the books of accounts as far as certain funds which have expired, because of the fact that there is an Indian income tax return which is filed, and there is a time limit for it to go under reassessment. So the current limit, while is 5 or 7 years from the end of the financial year, the proposed new timelines is 4 years from the end of the financial year. So this is a welcome move, but straight away they have they have also provided for an income escaping assessment, where the represented, or rather the escaping assessment in the context of the representation in the form of an asset which exceeds more than 50 lakhs, they can go back all the way to 11 years. So this is really damaging as far as somebody who needs to have a finality with respect to a particular fund is concerned, because if there is a income escaping assessment which is undertaken at a point in time, 11 years is a very long period, and there are uncertainties with respect to how this will be used. So this is again a subject matter of representation, and one will have to sort of see as to how the revenue authorities use these provisions on a going forward basis. There is a withholding tax which is to the extent of 0.1% on purchase of goods and payments to resident seller in specified cases, again not applicable specifically to non-resident. And I will not cover the next one because that's specifically exempted for a non-resident player. So maybe we can go to the next slide. Right. So coming to some of the other miscellaneous changes. The due date for filing of belated revised return, and for that matter issuance of scrutiny notices and completion of audit has been reduced by 3 months. So the deadline will now be lesser by 3 months. This is basically on account of the fact that now the government is moving on the digital arena, and much of the information is something which is available. The finance minister has also mentioned that the entire information with respect to public trading, with respect to capital gains, will be pre-populated into the returns. So a lot of information will be now available for either to the SEC as well as to the taxpayer, and therefore there is a need for crunching these timelines, and that is the rationale for reducing the overall limits by 3 months. So there is one important change. Faceless ITAT scheme is introduced on the lines of faceless appeal. Now, two important changes which has happened in the context of Indian administration. There is a faceless assessment, there is a faceless appeal. Both have gone live in terms of now going forward. the entire mechanism of administration will be undertaken on a faceless manner. And to sort of go further on that, the second level of appellate authority, which is the income tax appellate authority, even that is now moved to a faceless regime, which means that the entire regime will be on a faceless manner, and it will be on the same lines as any other appeal process. The third important element is in the context of fact that now they specifically define liable to tax in section 2. And point is liable to tax where it's not specifically defined under the tax treaty, but the definition provided here is in the context of the fact that somebody who is liable to tax but is not specifically rather specifically not paying taxes and is able to provide a TRC. So in the context of liable to tax, one important change which brings about is that if a specific fund is a pass-through fund, but its constituents are from a particular country and can sort of on a pass-through basis avail a tax treaty benefit, there could be now a challenge as to the fact that from a liable to tax perspective is tested in the context of the specific funds, and this is something that one will have to watch out as to how it pans up when it comes to actually taking the treaty benefit. The next one is in the context of authority for advance ruling. Now, authority for advance ruling is an authority which specifically pronounces ruling to a non-resident in the context of a transaction which is proposed. This ruling, this is while the entire regime was to advocate a regime where a non-resident can pre-hand understand the tax liability. However, there was a huge amount of backlog because of certain specific posts remaining empty, and therefore the entire regime was not effective. So now the government intends to entirely change this and create, or rather to replace the entire authority for advance ruling by a board of advance ruling, wherein specifically the board, which is constituted by two members, which will be at the grade of chief commissioner, will be part of this committee. And the important element is that the ruling which will be pronounced will not be binding on the FPIs as well as on the tax authority. So one really doubts as to what it will get, because if each of the authorities can specifically file an appeal, then at least from an SSC's perspective, it does not give a finality as to what would be its tax liability. But the fact of the matter is that the application can directly be, the appeal to the specific order can be appealed before a high court. So the element with respect to a particular assessment, where assessment goes from an assessment, if the revenue authorities are specifically challenging it, it goes through either a commissioner or a DRP and then moves to an ITAT and then moves to a high court or a Supreme Court. Here, at least, if the BAR, that is a Board of Advance Ruling, specifically gives a ruling which is not favorable to the SSC, they can directly move to a high court. So that is the change in the context of the new regime on BAR. Next slide, please. So yeah, these are the specific changes, especially relevant to a non-resident. And maybe I'll give it back to Sunil for final comments. Sunil, back to you.
Sorry, thank you, Anand. I think before we close the session, maybe we have, I think, about 10 minutes. So if there are any questions, we can probably answer them. So I think there's a Q&A window. So if any participants want to ask any question, maybe I'll just take a pause for a minute and see whether there are any questions. Okay, so we got the first question, which says that for an offshore FPI, would it be required to take a registration in the gift city to invest into Indian markets as per budget incentive to OBUs? I think Anand did briefly touch upon. So Anand, maybe you want to answer this question?
Yeah. Sorry, I'll just.
Okay, I'll just read out the question again. So for an offshore FPI, would it be required to take a registration in the gift city to invest into Indian markets as per the budget incentives to OBUs?
So if you already have a FPI license, then the specific separate license will not be needed. But if not, then a specific license will be needed for investment to specifically make investment into India.
Yeah. So I think if you have an OBU offshore banking units in the IFSC, and if that particular unit wants to invest into the Indian market, then you will have to take a registration. Okay, so the next question is, will the relief at source be available for dividend income under the new regime? Who will be responsible for gathering compliance documentation? Indian tax advisor, custodian, paying company? Okay, maybe I can answer, and Anand, you can chip in if there are any more comments. So yes, as Anand mentioned, I think the relief on account of tax deducted at source is available now, which is essentially, which will essentially mean that the dividend, tax on the dividend can be withheld at the rate applicable under the relevant tax treaty. In terms of the responsibility for gathering the documentation, I think it would have to be the dividend paying company. They will have to obtain, documents like TRCs, some evidences of the fact that the FPI or the foreign investor is a beneficial owner of the dividend income and so on. So yes, they can take help of their Indian tax advisor, but essentially under the law, it is the responsibility of the Indian company paying the dividend to actually collect the relevant documents.
Just to add further, on overarching basis, specifically the SSC will need SSC should be eligible, and from a substance perspective and from an MLI perspective, again, that is something one will have to see the eligibility again. So from currently from a TRC perspective, yes, the TRC is needed, but also that is an overarching thing for an SSC to overall check the availability of trading.
So we don't have any more questions at this point in time. Okay, so I guess if there are no further questions, then maybe we can close the session. So thank you so much for taking the time out and joining this webinar. We appreciate your you spending time on this, and obviously if anyone has any more questions, please feel free to reach out to us, and we will definitely come back to you with the answers. Thank you so much. Have a good day.
Thank you very much. Thank you.